Hello, I'm Chris Slight, the editor of Construction Europe magazine, and in this podcast I'll be talking about events on the world stock markets over the first quarter of the year and how they impacted on construction shares. As regular readers of the magazine will know, each month we take an in-depth look at a basket of more than 60 key equities in the contracting, materials producing and equipment manufacturing sectors. 2008 was of course a grim year. Construction shares lost more than half their value, and mainstream indexes like the Dow, FTSE and Nikkei were down between 30 and 40%. More details of this are available in the February issue of Construction Europe, and there is also a podcast on this topic available in the video zone of our website. So how has 2009 gone so far? Not too well is the answer. Shares were down across the board over the first 3 months of the year. The least worst, if you like, was the Nikkei, which lost 8.5% of its value. In comparison, the FTSE lost 11.5% and the Dow was down more than 13%. The construction sector, as measured by our CET index of 60 industry shares, was somewhere in the middle of that, with a fall of 10.18%. That was good in the sense that the losses for construction were in line with the mainstream indicators. As I mentioned earlier, this was not the case last year, when the sector fell much more heavily than those other benchmarks. As this graph of week-on-week movements illustrates, it could have been a lot worse. In early March, the Dow, FTSE and CET index were down more than 20% in the year to date. The quarter ended with a 3-week rally, which was in fact the second longest winning streak for the markets over the last 12 months, and that helped limit the damage. The driver for this small recovery was the $500 billion bank bailout package announced in the US. This public money will be combined with private investor funds to buy up the so-called toxic assets of the banks, removing them from their balance sheets and hopefully allowing them to start lending more freely. So that's the broad view. Now for some more detail on the construction sector. It was a mixed picture, and despite a loss of just over 10% for the industry as a whole, 19 of the shares we monitor on a regular basis enjoyed gains over the first quarter of the year. The top performer was escalator and elevator manufacturer Kony, which saw its share price more than double over the quarter. One of its key competitors, Schindler, also did well, with a near 10% improvement. But contractors from the Nordic region dominated the top 10, with Veidekke, Lemminkäinen, YIT, NCC and Peab all seeing double-digit rises. Europe's largest house builder, Taylor Wimpey, did well in percentage terms, but this rebound should be seen in the context of it losing more than 90% of its value over the course of 2008. In contrast, there were no contractors in the bottom 10, where honours were split between the materials producers and equipment manufacturers, with 5 companies from each sector featuring. Most of these losses came on the back of results announcements for the fourth quarter of last year. Markets for construction equipment were particularly badly affected following the collapse of Lehman Brothers in September and the ensuing squeeze on credit. Most equipment purchases are financed rather than cash purchases, so when credit stopped flowing, the market hit a brick wall. This meant that fourth quarter results were worse than expected and share prices took a knock as a result. This was all reflected in the performance of the different sectors. We monitor the contracting, equipment and materials sectors individually, and it is their weighted composite results that produce our overall index for the industry. In the context of the wider markets, the contracting sector had a strong first quarter. Although the sector fell, losses of only 5% were mild in comparison to the rest of the construction industry, and it was a performance that beat all of the major blue chip indicators. In fact, even though the materials sector, the heaviest faller, lost more than 13% of its value, it did no worse than the Dow's performance over the same period. So that was how the first quarter panned out for the stock markets. It was another tough period, with heavy losses coming on the back of a rough year in 2008. But the good news, if you could call it that, is that the construction sector moved in line with the mainstream markets, as opposed to falling much more steeply and deeply, which was the story last year. As I mentioned earlier, we look at share price movements every month in the finance pages of Construction Europe. If you would like to receive a regular copy of the magazine, please visit the subscription page of our website. Thank you.